Hello, ladies and gentlemen. I hope you are fine and you are enjoying these video lectures. Okay, in this video, we are going to look at International Financial Reporting Standard number 16. In the previous segment, we looked at Ifrs 15 revenues from contracts with customers, and I hope we have given justice to that topic. Okay, so in this video segment, like I said, we are going to look at leases. All right, so we'll start with the background of this accounting standard, why it repealed the former accounting standard number 17, and then we'll delve into the deeper expectations and the deeper treatments required in terms of International Financial Reporting Standard number 16 with regards to leases. So I hope you're going to pay more attention, okay, careful attention to this presentation, because hey, like as always, we are going to slice through, to dissect and bisect, to actually unravel everything with regards to leases. So please pay careful attention. Remember, we will be guided by the Acca syllabus, Acca financial reporting syllabus. All right, so we are not going to talk about every detail about this standard, but only those which we hope could actually be tested in our upcoming examination. Remember, our coaching is exam forecast. So please, without much ado, let me just get straight to the business of the day. Now, perhaps we should start with the definition of lease. A contract is or contains a lease if the contract conveys the right to control the use of an identified asset for a period of time in exchange for consideration. Okay, so it only becomes a lease if it conveys the right to control the use of an identified asset for a period of time in exchange for a consideration. So that's a lease, ladies and gentlemen. Now, there are a lot of definitions we should be accustomed to. For example, as you can see on the screen there, okay, there are a lot of definitions which would assist us to understand what is going on. But I hope you're going to pause the video and look at these definitions. They are self-explanatory. Okay, let us proceed to the very important areas of the presentation. Okay, these are the definitions, ladies and gentlemen. If you want to copy them down, but I hope you guys have got the textbooks, so you're gonna go through the textbook definitions and assimilate the important information for your studies. Okay, now this is the very important background which I hope we need to discuss about before we get deeper into the subject area. Okay, remedies brought about by Ifrs 16 and the standard's main features. Ifrs 16 sets out the principles for the recognition, measurement, presentation, and disclosure of leases. The objective is to ensure that lessees and lessors provide relevant information in a manner that faithfully represent those transactions. Okay, so it's about transparency these days, all right, and a discouragement of background transactions or off balance sheet transactions. All right, so this International Accounting Standard is attempting to ensure that the disclosures and the presentation of financial information is such faithful that prospective or current investors would be informed adequately and know when to make relevant decisions. It replaces IAS 17, which required lessees and lessors to classify their leases as either finance leases or operating leases, and account for these two types of leases differently. So initially, or before this, Ifrs 16 came into application. The requirement of IS 17 were that both the lessees and the lessor were supposed to account for leases, or to classify them as either finance leases or operating leases. However, this is no longer the requirement to lessees. To lessees. Lessees are no longer required to do this classification, although the lessors are still required to do so. Okay. Now, the main aspect which this accounting standard has brought about is the requirement to fully disclose the lease transactions. All right. Previously, it was only the finance lease that was more adequate. Okay, but the lessees would then have to account for operating leases as just expenses. Okay, so the issue there which was taking place was that operating leases were encouraging what is called off-balance sheet. Okay, off-balance sheet activities, where the liabilities and the assets which relate to these operating leases were not accounted for in the records or in the balance sheet of companies. Okay, so it was discovered that this was creating room for manipulation of financial information. All right, so with the coming of Ifrs 16, this was banned, okay, or was abrogated, and full disclosure was now required, or is now required, where every lease has to actually follow the same criteria with regard to the lessees books. Okay, the lessees. So Ifrs 16 introduces a single lease accounting model. Okay, lessee accounting model, whereby lessees, if you are a lessee or somebody, a tenant, you are required to just follow a single model of accounting for leases. Now, it requires a lessee to recognize assets and liabilities for all leases. So whenever you enter into a lease transaction, remember that you are going to have both entries for the assets, the lease, the right of use asset, and the lease liability. Okay, for all leases with a term more than 12 months. All right, unless the underlying asset is of low value. So it now boils down to the significance of the lease or the asset, the underlying asset, in terms of commercial or economic substance. For leases with a term of less than 12 months, that is a short-term lease, or low-value assets, an entity may elect not to recognize lease assets and liabilities, and instead the lease payments are simply charged to profit or loss as an expense. All right, so we are going to see an example very shortly, but we are simply saying if the underlying asset is of such an of an insignificant value, all right, or the lessee or the lease itself, the lease term is less than 12 months, the lessee has the right, okay, might elect to recognize those lease as expenses, okay, or lease payments as just expenses, and to be written off to the statement of profit or loss, rather than to disclose, to recognize an asset and a lease liability on recognition. Now, for all other assets, for all other leases, the lessee recognizes a right of use asset. All right, so which means for all other leases, like the long-term leases, the lessees are required to recognize a right of use asset. I normally refer this as the RUA, okay, the RUA, right of use asset. All right, representing its right to use the underlying asset, and a lease liability representing its obligation to make future lease payments. For lessors, there is little change from the IAS 17 requirements. So if you are the landlord, you are still allowed to just continue recognizing either an operating lease or a finance lease. Lessors will continue to recognize the distinction between finance and operating leases. Now, the major difference between the two, for those of you who might not have had the privilege of looking at International Accounting Standard number 17, the distinction is just, depends only on the risks and rewards. That's where the distinction between the two lies. Okay, in a finance lease, the risks and rewards are tied to the use of the asset, rests in the lessee. Okay, the tenant bears all the risks and rewards are tied to the use of the asset. Whereas in an operating lease, the owner or the landlord bears all the risks and rewards in relation to the use of the asset. So that's the main difference. The other difference is that usually operating leases are for a short period of time, whereas finance leases are actually for a longer period of time. Okay, usually in a finance lease, the tenant would have the right to own the asset at the end of the lease term. So those were the background, actually the main differences between the operating and the finance leases. Okay, let's try to move. Now, how do you identify a lease? There should be, remember from our definition, there should be a right to control an identified asset within a certain period of time. So which means an entity must have the right to obtain substantially all economic benefits derived from the use of the asset. Okay, so this should be direct use of the asset. Then the identified asset should be stated in the contract of lease, may be part of a larger asset. The lessor has no substitution rights. Okay, a similar asset cannot be used instead of the original leased asset. All right, so the lessor has no substitution rights over the use of the asset. Okay, so we are only going to continue to use that particular asset which is within the lease that has been identified. All right, so within a certain period of time, we are talking of the period of use in time or in units produced. Lease may only be for a portion of the term of the contract if the right to control the asset exists for part of the term. All right, so the lease may only be for a portion of the term of the contract. All right, not the other extra time. We only look at that particular portion of time where the contract is referring to. Okay, now let's move on to the other aspect. Let's try this example. You can pause the video and try the example on your own. Okay, this is an example which is testing us, our ability in identifying a lease. Okay, so it's an example on lease identification. Marondera Council has recently made substantial cuts to its community transport service. It will now provide such services only in cases of great need, assessed on a case-by-case basis. It has entered into a 2-year contract. Okay, this is a 2-year contract with Zupco Limited for the use of one of its minibuses for these purposes. So they went to Zupco and said, we just want a commuter omnibus service. Can you please assist us with a commuter omnibus service? Okay. Excuse me. The minibus must seat 10 people, but Zupco Limited can use any of its 10-seater minibuses. So Zupco has got a lot of 10-seater minibuses when required. The minibuses are held on Zupco's premises and are only made available to Marondera Council on request. So this company Zupco has got a lot of minibuses, and what Marondera Council wants is that they want a minibus to just ferry their people as and when required. Now, the question is there a lease between Zupco and Marondera Council? Obviously, there is no lease in this case. Why? Because there is no identifiable asset. So the answer is no. It's not a lease. All right. The other issue here is that the lessor, Zupco, can substitute the right to use of a particular asset. They can they can decide that today they give Marondera Council a yellow minibus. Tomorrow they give them another minibus. In the next day they're gonna give them a black, a blue, a red minibus. So it depends on what Marondera, on what Zupco deems fit on a particular day. So in such a scenario, we can't actually say there is a contract of lease that is at play. Okay, why? Because Marondera has no control on the use of the minibus, and the other reason is that the minibus cannot be identified. So the minibus implicit to the lease, okay, or related to the lease is not identified in this particular scenario. Let us look in the other scenario. This scenario has been extracted from the International Financial Reporting Standard number 16 itself. Okay, it is very useful, a very useful example. Cabocco enters into a 10-year contract with a utilities supply company called Telenuco for the right to use 3 specified physically distinct fibers within a larger fiber optic cable connecting Northtown to Southtown. Cabocco makes the decisions for the use of the fibers by connecting each end of the fibers to its electronic equipment. That is, Cabocco lights the fibers and decides what data and how much data those fibers would transport. If the fibers are damaged, Telenuco is responsible for the repairs and maintenance. Telenuco owns extra fibers but can substitute those for Cabocco's fibers only for reasons of repairs, maintenance, or malfunction, and is obliged to substitute the fibers in these cases. Can we conclude there is a lease? Obviously, in this case, there is a lease. Okay, if you still remember in our table here, we actually finished the whole thing. Okay, they should be right to control the use of the asset, and in this case, Cabocco has the right to use the asset. That is the 3 dark fiber cables. They are distinct, and it determines what type of information has to be conveyed. Okay, when is that information going to be conveyed, and to what particular equipment should they be connected to? So you can see that in this particular example, Cabocco has got the right of control in terms of controlling the use of the property. Then, is the asset identifiable? yes, the asset is actually identifiable because we are told in the situation, in the scenario that these cables are specified, physically distinct dark fibers. So the assets can actually be identified within a larger fiber optic cable. So we can actually see that these are the fibers in question. Then we can also see that cable core can make decisions on the use of the fibers. All right, it is actually unmitigated control. It has control over the use of the asset. For what period? For a specified period of time, and this is actually a 10-year contract. So the period is specified. Now there is an issue that might confuse this last segment, where we have got and also this other part, where the lessor has got some bits and pieces of intervention, okay, where they interfere when it comes to repair and maintenance. Okay, that cannot exclude this type of arrangement from being a lease. Okay, the fact that the lessor or the landlord sometimes do some repairs to his building cannot exclude the contract from a lease. Okay, that one is an arrangement which is necessary, but is not going to distort the use of the property to the lessee. Okay, so the lessee too has the outright ability to detect or to command the use of the leased property, which are the three distinct dark fibers. So in this case, we can actually see that the lease is at play. Now let's move on to issues to do with measurement. Okay, let's start with the lease liability. The initial measurement. The lease liability is initially measured at the present value of the lease payment. Okay, the present value of the lease payment, and this lease payment should include the fixed payments, which could be paid annually or monthly, and then amounts expected to be payable under the residual value guarantees. And what are these? Residual value guarantees are when the lessor is guaranteed that the underlying asset at the end of the lease term will not be worth less than a specified amount. So this value is actually guaranteed. All right. Options to purchase the asset that are reasonably certain to be exercised. Okay. Then termination penalties if the lease term reflects the expectation that this will be incurred. Now, when we talk of present value, there should be a discount rate. Okay, the discount rate, and this discount rate should be the rate implicit in the lease. All right. Now, if this cannot be determined, then the end should use its incremental borrowing rate, the rate at which it could borrow funds to purchase a similar asset. And let me just try to open the approved textbook. Okay, this is the BPP. Okay, sorry. All right, the PPP for those who would want to buy this. Okay, the BPP Learning Media textbook. Now, interest rate implicit in the lease, the discount rate at the inception of the lease, okay, which causes the aggregate present value of the lease payment and the unguaranteed residual value to be equal to the sum of the fair value of the underlying assets and any initial indirect cost. So, in other words, we are talking of the discount rate for amortization of the lease. All right, because by the end of the day, we should narrow down to a figure that is equal to the amount that was required by the end of the day. All right, so you will see as we do this amortization. All right, what about the right of use? How is it measured initially? Initial measurement, right of use asset. Now, the right of use asset is initially recognized at cost. The initial cost of the right of use asset comprises of the amount of the initial measurement of the lease liability as above, then lease payments made at or before the commencement date, and initial direct cost, the estimated cost of removing or dismantling the underlying asset as per the condition of the lease. This is very, very essential, especially on multiple choice questions, and these should actually be cast on the stone of your heart. All right, what about subsequent measurement? How do we measure thereafter? Now, for the liability, the carrying amount of the lease liability is increased by interest charge, calculated as the outstanding liability multiplied by the discount rate of interest. This interest is also recorded in the statement of profit or loss, that we debit finance costs in the statement of profit or loss and credit lease liability, that is to increase the lease liability in the statement of financial position. The carrying amount of the lease liability is reduced by cash repayments, and whenever we make a cash repayment, we then have to debit the liability, that is to decrease the liability, and credit cash too, because the cash has left our pocket. To work out the interest and year-end liabilities, the lease liability table, similar to the Ifrs 9 loan amortization table, is often used. The layout of the table would depend on whether the payments are made at the end of the year, that is in arrears, or at the start of the year, that is in advance. So if it is in arrears, we're going to have an amortization table like this one, where we have got the year, the opening balance, okay, the interest, okay, usually at the rate implicit, for example 5%, and then reduced by the payments which are deducted, and then we have got the closing liability, okay, or let me just say the closing or the balance CD, okay, balance CD. All right, that's for the the in arrears arrangement, okay, when the payments are made in arrears. Now, if the payments are made in advance, we're going to have the year, right, the year, opening balance or balance BD, right, and then we have got the payments. Then we've got the subtotal, okay, and then we have got the interest at say 5%, all right, and then we have got the closing balance. That's it for the in advance arrangement. Okay, now let's move on. Now, the subsequent measurement of the right of use asset. The right of use asset is measured using the cost model, okay, unless another measurement model is chosen. What is the meaning of the cost model? The cost model refers to the situation where the carrying amount of an asset is going to be given by the original cost less an accumulated depreciation and any amortization, any impairment. All right, so that's the cost model. This means that the asset is measured at its initial cost less accumulated depreciation and impairment losses. Depreciation is calculated as as follows. If ownership of the asset transfers to the lessee at the end of the lease term, then depreciation should be charged over the asset's useful life. Otherwise, depreciation is charged over the shorter of the useful life and the lease term as defined previously. So you should have to listen very carefully to the wording within an examination question, because if the ownership of the asset is going to be transferred to the lessee at the end of the lease term, then the depreciation charge should be charged over the asset's useful life. Okay, so you might be given a situation where the useful life of the asset is 5 years and the lease term is actually going to be 3 years. All right, you are going to be tempted to use this last scenario there, where the depreciation in this case should be based on 3 years. However, if the asset is going to be transferred to the lessee at the end of the lease, then depreciation should be based on the 5 years, which is the duration the life of the useful life of the asset, the useful life of the asset, and this was the term of the lease. All right, so when the asset is going to be transferred, then our depreciation should be based on the useful life of the asset. Otherwise, the depreciation should be based on the shorter of the useful life and the lease term. Now, ladies and gentlemen, this diagram here is, I saw it as very, very important for our understanding of what is going on with lease accounting. Okay, so the basic principle: at the commencement of the lease, the lessee should recognize a lease liability as well as a right of use asset. All right, that's the basic principle. So this is why we are seeing the right of use asset there and the lease liability there. All right, that's the basic principle of lease accounting. However, this lease liability should be recognized as a non-current, and so both the non-current and current components of the lease liability should be identified. So what are we saying? Initially, when you are recognized a lease, you should debit the right of use asset, okay, in the statement of financial position, and then credit the cash, any initial cash deposit that has been deposited to the lessor, and then the credits, you need to credit the lease obligation for present, that is the present value of future cash flows. All right, so what does this all mean? It means that the right of use asset is actually the balancing figure. Okay, you need first to determine the present value of the future cash flows, and then you have to also add any cash deposit that has been made for you to arrive at this figure. So the two items have to be identified because they feed into what is called the right of use asset. Remember, we said that the right of use asset is made up of, remember here we say that the right of use asset is made up of the amount of the initial measurement of the lease liability and the lease payments made at or before the commencement of the lease, and then any indirect cost. So all these figures have to then known. Then after you know these figures, then you have then to calculate the right of use as the aggregate of those figures. Okay, now we also have to look at a situation where we have got a sale and leaseback transaction. All right, so there are two scenarios where the transfer is a sale in terms of Ifrs 15 and where the transfer is not a sale. So if it is not actually a sale, then you need to continue to recognize the asset and treat proceeds as a loan. And if we are treating the proceeds as a loan, then we also have to know that Ifrs 9 comes into play. Okay, so let's proceed, ladies and gentlemen. I just wanted to show you this diagram so that you understand what is going on in a bird's eye view perspective. Okay, now the main points about Ifrs 16 before we delve into the relevant examples. Now, the right of use assets and the lease liability are calculated at the same time on inception of the lease. Yes, like I said, you need to first of all determine the PV of the future payments which are going to be made to respect of the lease, and then the initial deposits. You have to know them so that you then calculate the right of use asset. The right of use asset is depreciated over useful life, right? If useful life and lease term are different, we use the lower period for the calculation of depreciation. That is, whichever is lower. However, if the asset is to be transferred to lessee at the end of the term, then the asset's useful life is to be used. Lease obligation will be amortized. Okay, remember we talked of the amortization schedule. Then standard does not apply to leases of low value items and leases up to 12 months, and we say that these should be expensed to the P&L. They are expensed to the statement of profit or loss as they are incurred. Alright, so those were the main points you need to bear in mind. Now let's start with this particular example. A lorry has expected useful life of 6 years. It is acquired under a 4-year finance lease. Over which period should it be depreciated? And you need to stand on your principle. Okay, this is the question, ladies and gentlemen. We said that if the asset has to be transferred to the lessee at the end of the lease term, then the depreciation charge in respect of that asset has to be based on the useful life. However, in this particular question, we are not told of that intention. Okay, we are not told of that arrangement. So therefore, we just have to use the default position, which is the lower of the lease term and the useful life. In this case, the useful life is 6 years, okay, and the lease term is 4 years. So the lower period is going to be used. So depreciation will be based on the lease term. Which is lower. It is the lower figure there. Now, what about leases of low value? Stella call leases a tablet computer. How should this be treated in its financial statements? Now, we said that these low value items or leases of less than 12 months, the edits can opt, right, to expense those expenses to the statement of profit or loss. So this is a low value item. Therefore, Stella should expense the lease rentals to the SPL. Okay, she should expense the lease rentals to the statement of profit or loss over the lease term. Okay, over the lease term. All right. Now, the items which separate boys from men are these ones now. Where we'll be looking at the amortization issues. Now, here, in this particular example, the payments are being made in advance. On 1 April 2027, Fielder entered into a lease agreement for an item of equipment. So the date was 1 April 2027. The lease required 4 annual payments. So 4 annual payments in advance of 215,000. So these are in advance. Commencing on 1 April 2027. The equipment has a useful life of 4 years and will be scrapped at the end of the lease period. So the useful life is 4 years, and this is also a 4-year lease. All right. The present value of the total lease payments is 750,000, and the interest rate implicit in the lease is 10%. So the computation for the present value of lease payments has already been done, and this is our opening balance of the lease. Okay, it's our opening balance on the amortization schedule. How will Fielder reflect this transaction in its financial statements for the year ended 31 March 2028? So let us look at how Fielder will then have to reflect this in its financial statement. All right, so the amortization schedule, ladies and gentlemen, this is for an in advance situation. The payments are made in advance. So we start with the year, all right, then opening balance, okay, and then the payments come immediately. And then we have got the subtotal. Then we charge interest on the subtotal. In this case, we are told that the discount rate is 10%. Okay, so the interest is at 10%. And then we have got the closing balance. Okay, now in year 1, the opening balance is 750,000. Okay, and then we make payments of how much from the question. The payments are 215. These are the payments which are made as fixed payments. These ones, they do not change, they're just constant. Okay, so 215 every year. So the subtotal there becomes 535,000. Then we charge 10% on this 535, so it becomes 53500. Okay, and our closing balance would be 588,500. Okay, but we need to understand that the closing balance here would be having both the non-current liability and the current liability. So how do we then separate the current and non-current liabilities? We need to be very systematic. So for us to do that, we need to work out the year 2 figures. All right. However, since this one is an advanced situation, so the year 2 figures are not important. We can simply determine the current and non-current liabilities by actually using logic. What we know in the advanced situation is that we need to make payments. Okay, we need to make payments at the start of the year. So therefore, the payments become, the next future payment becomes the current liability, and the non-current liability becomes the balancing figure. So in an advanced setup, the computation is very easy. Always the current liability would be the future, the next future payment, which is, and this one is not going to change usually. They are just the same throughout the lease period. Okay, so our current liability is automatically 215,000, but the non-current liability, that's the balancing figure. Okay, that would be the balancing figure. That is, for the non-current liability, you just have to say 588, 500 minus 215, and you realize that this should be 373. So this is 373,000. That's our non-current component, the non-current liability component. Now, if this lease was having its payments made in arrears, then the table was going to look like this. All right, we have the year, the opening balance, then we have the interest immediately after the opening balance. In this case, the interest is at 10%. Then we have got the payments. Then we have got the closing balance. So year one, we opened with 750,000, and then the interest was at 10%. So 10% of 750,000, that's 75,000, and then the payments are 215,000 every year. Okay, so we are going to have the closing balance of 610,000. But for us to determine the current and non-current liabilities, that's when we need to do the year two column. I mean row. So for the year two, we take the closing balance will become our opening balance, so for 610,000. Then we multiply by 10% the interest. This gives us 61,000, and then we less 215. Okay, so that's 610,000 plus 61,000 minus 215,000, and that must give us let me use this calculator. Okay, we get 456,000. So the purpose of doing year two figures is for us to determine the current and non-current liabilities component for year one. So we can now see that in year one, the non-current liability, okay, the non-current and current liabilities are as follows. The non-current is actually the closing balance in year two. Okay, that's the closing balance in year two, which is 456,000. This is the non-current liability. Now, for the current liability, the current liability is the difference between this amount and the closing balance in year two, which is 456,000. 610,000 minus 456, and that would be 154,000. So this is 154,000. Okay, or the difference between these two figures. That's the current liability. Are we together, ladies and gentlemen? So that is the case in an arrears situation. If payments are made in arrears, this is what you are supposed to do. Okay, I hope we are done there. Okay, let's try this other example. Connecticut entered into an 8-year lease agreement on 1 July 2024. The present value of the lease payments at 1 July 2024, discounted at a rate of 6%, is 4,657,500. Additionally, Connecticut paid directly attributable cost of 37,500 on 1 July 2024. Okay. What is the total charge to the settlement of profit or loss for the year ended 30 June 2025 in respect of the right of use asset? Okay, so initially we recognize the right of use asset, okay, and the lease liability. All right, so we credit the lease liability and any payment which would have been done. So the lease liability in this case was determined to be 4,657,500, and there was payment of 37,000, so cash paid. That was 37,500, and we add these two figures to get our right of use asset. Remember, we said that this is the aggregate of the any direct cost that was paid at the inception of the lease, as well as the present value of future lease payments which are not yet paid. So that's 465,750 plus 37,500, and we get 46. That's the right of use asset is 4,695,000. Okay, that's the value of the right of use at inception. Now, the question says, what is the charge to the profit or loss? The right of use asset is a balance sheet item. We want the figures that have to be put to the statement of profit or loss for the year ended 30 June 2025. So we then have to know that there are two figures which have to be transferred to this statement of profit or loss. We have got the depreciation charge as well as the interest charge for the finance cost. So the total of those. Okay, so let us calculate the depreciation charge. Depreciation is based on the lease term, 8 years. So this is an 8-year lease. So the depreciation charge is actually going to be the value of the right of use asset. We determine it to be 4,695,000 divided by 8. How much do we get? So that's 586,000. So this is 586,875. Okay, that's the first figure. Remember, this is the first figure. Then we have to determine the finance cost. All right. Now, the finance cost is determined by whether we are going to use the in advance or in arrears arrangement. Now, given the information on the question, you can see that to use the in advance option is not going to be palatable, or it's not going to be feasible. So you can infer that this arrangement was actually in arrears arrangement. Okay, so we do not have information about the payments and when were they being made. So the only option that is viable given the information there is that it should be a situation where the payments are being made in arrears. So if that is the case, we then have to have our amortization table like this one. Okay, we have got the year, okay, the year, the opening balance brought forward, and then we have got the interest. In this case, the interest rate was 6%. Okay, and then we have got the payments. All these other columns are irrelevant for now. They are irrelevant because our answer is just the finance cost, because the interest column is the one which gives us the FC, the finance cost. So in year one, the balance brought forward was the right of use asset, which was the liability, not the right of use asset actually, but the liability. okay, we need to take this liability. That's the figure that goes in there. Okay, that's the figure that goes in there. All right, so don't mix up these figures. Depreciation is used to calculate the right of use asset figure is used to calculate the depreciation. However, when it comes now to the amortization, we are amortizing the lease liability. So the opening balance should be the present value of the lease payment. In this case, we say this is 46 as determined. You just have to copy and paste this figure. Okay, you copy and paste it to this particular cell. That's 4657,500, and then you charge your 6% on that figure. So 6% of 4657,500 should be 279,000. 279,450. Like I said, the rest is irrelevant because the question wants us to determine statement of profit or loss figures. Okay, those are the figures which are required. So that's 279 plus the depreciation, 279,450. So you need to add them up to get the output balance. So if you add up these figures, you can see that the amount we need is this one. This is the total charge to be transferred to the statement of profit or loss in respect of this particular asset. So it's not confusing. You just have to be systematic in your approach and understand what would be going on within a particular question. Excuse me. Let's move forward and see if we can finish this issue in the quickest possible time. Now let's look at sale and leaseback transactions. If an entity, that is the seller lessee, transfers an asset to another entity, the buyer lessor, okay, sorry, and then leases it back from the buyer, the seller lessee must assess whether the transfer should be accounted for as a sale. For this purpose, the seller must apply Ifrs 15 revenue for contracts with customers, the accounting standard which we have just completed, to decide whether a performance obligation has been satisfied. This normally occurs when the buyer obtains control of the asset. Control of the asset refers to the ability to obtain substantial all of the remaining benefits. So if this is not the case, then it wasn't a sale at all. Okay, now there is a situation when transfer is not a sale. If the transfer is not a sale, then the seller lessee continues to recognize the transferred asset and will recognize a financial liability equal to the transfer proceeds. In simple terms, the transfer proceeds are treated as a loan, that is financial liability, and accounted for in terms of Ifrs 9. Thus, the transaction is more in the nature of a secured loan. So, see the diagram on Ifrs 9 next here. So, I encourage you to make use of this diagram whenever you want to make decisions on how you are going to treat or to account for this financial liability. Okay, in terms of Ifrs 1, we have got, Ifrs 9, financial liabilities are by default measured at amortized cost. Okay, as you can see in this particular diagram, they are measured at amortized cost. Sorry, I don't know what's going on with my pen. All right, okay. Okay, so they're recognized at amortized cost. That's the default position where we are saying the purchase value, they're recognized at the purchase value less and issue costs and any discount. Okay, so that's how, and we'll be using the amortization schedule, unless if they are being held for trading, which means they would be measured at fair value through profit or loss. Okay, I would also encourage you to refer to the video which I did in respect of this subject matter on our week 6 learning phase. So refer to the week 6 video, and the link is actually on the description below. Okay, let's move on now. What about when the transfer is actually a sale? Okay, if the transfer is actually a sale, then we then have to sweat a little bit. All right, if the transfer does qualify as a sale, then the seller lessee must measure the right of use asset as the proportion of the previous carrying amount that relates to the rights retained. This means that the seller lessee will recognize a profit or loss based only on the rights transferred to the buyer lessor. Okay, I think an example would be most appropriate in this regard. On 1 January 2021, Spot on Homes SOH, a home construction company, sells an item of machinery to Bricks Limited for its fair value of $3 million. The asset had a carrying amount of $1.2 million prior to the sale. This sale represents the satisfaction of a performance obligation in accordance with Ifrs 15 revenue from contracts with customers. SOH enters into a contract with Bricks for the right of use of the asset for the next 5 years. Annual payments of $500,000 are due at the end of each year. The interest rate implicit in the lease is 10%. The present value of the annual lease payments is $1.9 million. Okay, the remaining useful life of the machine is much greater than the lease term. Okay, so we are told here, we are being hinted that the remaining useful life of this particular asset is much greater than the lease term. Obviously, we then have to know that if we are calculating any depreciation, we have to be guided accordingly. Explain how SOH will account for the transaction on 1 January 20X1. So let's then determine how we need, this is a dollar sign. Okay, so let's do the computation. Let me look for the space. Okay, so the sale satisfies Ifrs 15. Okay, this is Ifrs 15 compliant, so which means the sale was actually a real sale. Okay, which means Spot on Homes should recognize the asset from its books. Okay, they should recognize the asset, and they then have to recognize a right of use asset. They recognize the asset and then recognize a right of use asset. So how is this right of use asset going to be measured? It is going to be measured as the proportion of the previous carrying amount. Okay, the previous carrying amount that relates to the rights which are retained. So the right of use asset should be the proportion of the previous carrying amount. Okay, the previous carrying amount of the asset. Okay, relating to rights, the rights retained. All right. The previous carrying amount was actually 1.2. Okay, but we then have to determine the rights retained based on the present value of the lease payments which are going to be made, okay, vis-a-vis the present value of the asset. So the lease payments are 1.9 million. Okay, so our right of use, the right of use asset, is going to be the present value of future payments versus the future the fair value, which is 3 million, multiplied by the carrying amount. The carrying amount was 1.2 million. So in this case, we are going to have 0.76 million as the rights retained. And that's our right of use asset. All right. So what is going to be the double entry in this case? Because we sell this item at 3 million, okay, but the present value of the lease payments are 1.9 million. All right. So we have received 3 million. That is the reality of the situation. So we are going to debit the 3 million cash received. All right. We are also going to debit the right of use asset, which is, we have determined it to be 0.76 million. Okay. And then we need to derecognize the asset from our records. Okay, so we are crediting the asset, which is the machine, which has been disposed of, and we dispose of the carrying amount. Okay, the carrying amount, remember the asset was having a carrying amount of 1.2 million. So this one is being derecognized, is gone off. All right, and then we have to realize a lease liability. Okay, and in present value terms, the present value of the lease liability was 1.9 million. Okay, please see it clearly. All right, see that clearly. Okay, this is the dollar sign, it's just a typo. Okay, so that's 1.9 million dollars. All right, so that's our lease liability has to be credited. Lease liability 1.9 million, and then a transfer to the profit or loss should be a balancing figure, P&L balancing figure. And if it is still a credit, if the balancing figure is on the credit, then there's been a profit. Okay, so this one is a credit, 0.66 million. Okay, I hope you're following. Okay, so please note that this particular gain we are talking about is actually the proportion of the overall 1.8 gain. So this is actually a proportion of the overall gain on disposal of $1.8 million. Okay, remember we disposed the asset for 3 million when the carrying amount of the asset was 1.2 million. So there was 1.8 overall gain, and this 0.66 million is just the proportion. Okay, what do we mean? We are saying that since we fetched 3 million minus the lease liability of 1.9 million, okay, multiply by this 1.8 million, you can see that we get 0.66, which is the portion of the gain. Okay, you get 0.66, which is the portion of the gain. The right of use asset and the lease liability will then be accounted for using normal lease accounting rules. Okay, so once you have finished these computations, then you then have to account for the right of use asset and the lease liability using the normal Ifrs 16 techniques. All right, so before we call it quit, do you feel like you need extra coaching? Okay, do you need further coaching so that we assist one another on the way forward? Okay, this is our territory and we need to assist one another. You might as well have a friend who is in need, who is looking for a tutor. I am there to assist them. So just use your WhatsApp. This number is WhatsApp compliant. Okay, you can send a hello message to me and then we facilitate the coaching, or you can just send an email so that we engage as brothers in this Acca terrain. Okay, so until next time, may we please continue to meet one another in the next videos. I am signing out. Thank you. My Lord has done it to all. My Lord has done it to all. My Lord has done it. He has done it to all. My Lord has done it to all. My Lord has done it to all. My Lord has done it. He has done it for me. Okay, this question has been requested by my stakeholders. Okay, as we are serving a wider community, others have actually requested this question to be attempted. Okay, so we are going to attempt it following the rules which we have already proffered. Okay, so we just have to take at least 3 minutes on this particular question. All right, we had signed out, but we need to listen to our stakeholders. Their concerns matter. So we've got Bassett PLC, which entered into a 3-year lease on 21st January 20X1 for a crane. Lease payments are $10,000 per year for the first 2 years and $15,000 for the third year. All payments are due at the end of the year. The present value of the lease payments was $31,552, and Bassett incurred initial direct cost of $3,000. Bassett's borrowing rate is 5% required. Show extract of Bassett's statement of profit or loss and statement of financial position in respect of the lease agreement for the year ended 31 December 2021. So what we need to do is, first of all, we need to discuss or to pinpoint the double entry at inception. So the double entry at inception is we need to recognize a right of use asset okay, and the lease liability. All right, so we need to credit the any cash payment that was paid and credit the lease liability or the lease obligation. Now, the lease obligation is the present value of future lease payments which are yet to be paid. So in this case, the lease payments have been calculated for us and they were 31,552, and any cash which was paid at the start, this was 3,000. So if we add up these two figures, sorry, it's 3,000. If we add up these two figures, we get our right of use asset, which is the balancing figure, remember, of 34,552. Okay, now we then have to construct our amortization table to determine the subsequent measurement. So the amortization table, ladies and gentlemen, remember the payments are in arrears, payments in arrears in this particular question. So the amortization table will look like this. Okay, we've got year one, the year, we've got the opening balance column, the interest, and we are told that the interest in this particular question is how much? Is 5%. So at 5%, then we've got the payments to reduce the liability, and then the closing balance. So we underline, we have got our year one, and in our year one, the opening balance should be the present value of the lease liability, the lease payment. So in this case, the lease liability figure, which was 31,552. Okay, 31,552, and then we subject it to the interest. What is the interest charge in respect of that lease liability? That's 5%. Okay, multiplied by 31,552, we get 1,577.6. Okay, once we do that, we then have to deduct the payments, and we are told that for the first 2 years, the payments were 10,000. So they are paying 10,000 for the first 2 years. So if we add 31,552 plus 1,577.6 minus 10,000, we are going to have a closing liability of 23,129.6. Now the question, ladies and gentlemen, is say that you need to determine the amount, the extract statement of profit or loss and statement of financial position. So for the year 20x1 December. All right. Now this is our year one figure. So we need the figures in both the statement of financial position and statement of profit or loss for the first year. So we then have to follow the rules. And in the previous similar example, I said if the payments are going to be made in arrears, therefore for you to determine or to separate the current and non-current liabilities, you then have to do year the year two figures. So let us do the year two. So year two, we just take our opening balance will be the closing balance in year one. The closing balance was 23,129.6. Okay, and then we multiply by 5%, 23,129.6 multiplied by 5%, we get our 1,156.8. Then we deduct 10,000, and the closing balance would be 14,286.40. Now, once you get these figures, then it becomes easier for you to determine which one is the current liability and which one is the non-current liability. The non-current liability is, for year 1, is the closing liability in year 2. So the non-current liability becomes 14,286.40. And the current liability becomes the difference between this amount and this amount. So the difference here is actually the current liability. So this gives us 8,843, okay, 0.3. Okay, so these are the first two figures which are required in the statement of financial position. The other figure we need is then the right of use asset. So the right of use asset is going to be the initial cost less depreciation. Okay, so first of all, let's calculate the depreciation charge. The depreciation charge is based on the initially recognized value, that is 34,552. Okay, 34,552 divided by the lease term, and the lease was for how long? For how long? It was for 3 years, so we divide by 3. Remember, we are using the cost model. So 34,552 divided by 3, and we get how much do we get? This calculator of mine, it's telling me that we get 11,570. So that's the depreciation for the year. So our right of use asset would be the original cost of 34,552 minus depreciation of 11,517. This gives us the right of use asset of 23,035. So at the end of the year, the assets value becomes 23,035. So the SFP values have been found. Okay, SFP values have been found. This figure, that figure, and that figure. What about the statement of profit or loss values? So SPL extract will show firstly the depreciation charge, which we determined as this one, that's 11,517. Also, we will show the finance cost. The finance cost is going to be given in the column here. This is the column, the interest column. So for the finance cost for year 1 is that one, 1,577.60. Okay, now sometimes the question might require you to determine the total charge. The total charge. So the total charge to the statement of profit or loss would be 11,517 plus 1577.6. So the total charge should be 13,094.6. Okay, so that is it, ladies and gentlemen. I hope you have been assisted with this presentation. And like I said, please, if you have somebody who is in need of a tutor for financial reporting or any of the Acca modules, please don't hesitate to contact me. This is my number. It is WhatsApp compliant. Okay, you can just send a hello on WhatsApp, or you can even email me. I will be online anytime, any day. Okay, as long as the Lord permits, as long as the Lord gives me the life, the precious life. So I thank Him, the Most High, and I thank you guys for your support. Don't forget to subscribe to this video if you find it useful, and continue to share and click the notification bell so that you'll be notified whenever I upload the videos. Until next time, ladies and gentlemen, you continue to feel very, 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 very excited. I am signing out. Bye.